All right, so we're diving deep today
Deep.
into some pretty hefty documents that you sent over.
Absolutely.
The Q1 fiscal year 2025 earnings report, and then
Of course.
the Form 10Q.
Yeah, the 10Q filing. Gotta have it.
And really what we're trying to do is, you know, I mean, these things are dense.
Right.
They're full of jargon.
Absolutely.
We want to cut through all that and give you, the listener, like a solid understanding of what the numbers are actually saying about this company, how they're doing.
You got it.
So, let's...
I think of it this way.
Yeah.
You've got the earnings release, and that's your highlight reel, right? That's management giving you the, the top level view.
Yeah.
The pretty picture.
The spin.
Yeah, a little bit of spin.
Yeah.
But then you've got the 10Q, and that's the game film.
Okay.
That's where you really get down into the nitty gritty.
I like that analogy.
Yeah.
Okay.
You get the full financial statements. You get those footnotes. Those are super important.
Yeah.
Those give you the context. And we're here to
put it all together.
Bring it all together. Yeah.
Yeah. Awesome.
Make sense of it.
So let's start with those headline numbers.
Okay.
For the first quarter of fiscal 2025.
All right.
See how those compare to last year.
Sounds good.
Revenue up 5%.
Okay.
Hitting $24.7 billion.
All right.
What's your initial reaction to that?
I mean, for a company this size, 5% revenue growth, that's pretty significant.
Okay.
That shows that there's some real underlying growth happening in their various businesses.
Yeah.
And it seems like that momentum's carrying over to their profitability as well.
Okay, because net income attributable to the company jumped to $2.6 billion from $1.9 billion.
It did.
So that's a pretty healthy climb.
Yeah, no, that's a big jump. And then when you look at it on a per share basis, diluted EPS went up to $1.40 from $1.04. So that's a 35% increase.
That's substantial.
Yeah. But then they also report this adjusted diluted EPS, which is even higher.
Okay.
It's $1.76 compared to $1.22, so a 44% increase.
Okay, so what's the deal with these adjusted numbers?
Yeah, so companies like to use these non-GAAP or adjusted measures to sort of present what they see as their core ongoing business performance.
Okay.
They take out some items that they consider to be unusual or non-recurring.
Okay.
So in this case, they're excluding things like restructuring charges.
Okay.
And the amortization of intangible assets related to past acquisitions. Okay. Like TFCF and Hulu. Right. So it gives investors sort of a
different lens.
Yeah, slightly different perspective.
Yeah, on their profitability.
Okay, I got it.
Yeah.
So looking at the cash flow picture then, we see cash provided by operations.
Right.
Up big time.
Yeah.
47% to $3.2 billion.
Yep.
Sounds great.
Yep.
But free cash flow dipped 17% to $739 million.
Yeah, that seems a little contradictory on the surface, right?
Yeah.
But what's interesting here is if you dig a little deeper, free cash flow is a non-GAAP metric.
Right.
And the company actually points out in the filings that the growth in cash provided by operations is really the most directly comparable GAAP measure.
Okay.
And the big reason for that decrease in free cash flow is they're investing a lot more money in parks, resorts, and other property.
Right.
They spent $2.466 billion this quarter.
Oh, wow.
Compared to $1.299 last year.
Yeah. So they're generating way more cash from operations, but they're also putting a lot of it back into
reinvesting.
Yeah, these long-term growth initiatives.
Right. That makes sense.
Yeah.
Investing in those physical assets.
Right, exactly. It's a long-term play.
Yeah.
Even if it impacts free cash flow a bit in the short term.
Right, exactly. Yeah.
Yeah.
Okay, so one really big thing that happened this quarter was
this is a big one.
The Star India transaction.
Right.
And I'm curious how that's kind of shaking up all these numbers. It sounds like kind of an unusual situation.
It is.
Because it only covers part of the quarter, right?
Right. So the first quarter of fiscal year 2025 only includes about a month and a half.
Oh, wow.
Of Star India's operating results because the deal closed on November 14th, 2024.
Okay.
So to compare that, to the prior year quarter, Q1 FY20 included a full 3 months of Star India.
Yeah. Okay.
And then after November 14th, their stake in that India joint venture, that's accounted for as equity in the income of investees.
Got it.
That's a separate line item on the income statement.
Okay, so the direct revenue and operating income figures for Star India aren't really comparable then?
Not directly, no.
Okay.
And this shift has some other interesting consequences too. Their effective income tax rate went up from 25.1% to 27.8%.
Wow.
And that's partly due to a non-cash tax charge related to the Star India transaction.
Okay, so it sounds like there was some immediate financial impact, like just from the transaction itself.
Yeah, absolutely. So they recorded a $143 million loss.
Okay.
And a $213 million non-cash tax charge related to wrapping up that Star India deal. And then if you look at the performance of their different segments, the sports segment shows a really big drop in Star India revenue.
Right.
It's just $39 million this quarter.
Wow.
Compared to $399 million in the same period last year.
Yeah, that's a huge drop.
Yeah, it's dramatic.
Yeah.
And then operating income for Star India swung from a $9 million profit to a $315 million loss.
Wow. Okay, so big changes there. And then what about that equity in the income of investees line?
Right.
I mean, just for folks at home, that's basically their share of the profits or losses from ventures that they've invested in but don't own outright.
That's it.
So what happened there?
So that came in at $10 million, which is actually down from $13 million in the prior year.
All right. So really seems like things in India
it's a whole new ball game.
Yeah, exactly. Yeah. Okay, let's move on then to the performance of the individual segments.
Sounds good.
Starting with entertainment.
Okay.
It seems like there's some positive momentum here.
Yeah.
Revenue up 9%.
It is.
What's driving that?
Yeah, so the entertainment segment, they saw growth in a couple key areas. Direct to consumer was up 9%. Content sales licensing and other showed a really strong increase. 34%.
Right.
This was partially offset by a 7% decline in their linear networks. But overall, operating income for the segment surged 95%.
Wow.
And that was largely due to those improvements in direct-to-consumer and content sales licensing.
Okay, so let's drill down a little bit into those subsegments.
All right.
Linear networks revenue took a hit. What's going on there?
Yeah, so the dip in linear networks revenue is mainly due to fewer subscribers for their traditional cable channels.
Right.
They did see some benefit from higher rates that they were able to charge. But the subscriber losses were the main factor. They also pointed to higher programming costs, mainly at ABC Network. And they attribute that to a higher average cost mix, reflecting the impact of the 2023 guild strikes on that comparison period.
Interesting.
Yeah, and then interestingly, they did see an uptick in advertising revenue driven by political advertising at their own television stations. Although that was partially offset by lower overall viewership.
Okay, so temporary bump from political ads there.
Exactly.
Now, direct-to-consumer, obviously, a huge focus.
Huge.
What are we seeing with subscriber numbers for Disney Plus and Hulu?
Right, so these subscriber numbers are a bit of a mixed bag when we compare, the end of December 2024, the end of September 2024. Total Disney Plus subscribers saw a slight decrease, 1%.
All right.
But if you break it down, domestic Disney Plus, that's the U.S. and Canada, actually grew by 1%. But that was more than offset by a 2% decline in international Disney Plus subscribers.
Got it.
Hulu, on the other hand, showed overall subscriber growth 3%, with the SVOD only service up 3%, and then Hulu Live TV plus SVOD remaining flat.
Okay, so a bit of a slowdown on the Disney Plus international side.
Yeah, looks like it.
But Hulu still trending upward.
Trending up?
Yeah, that's a key distinction there. Now, what about the average monthly revenue per paid subscriber.
ARPU.
ARPU. Yes. That's a closely watched number.
Everybody's watching ARPU.
They are.
Yes. So this is where we see some encouraging signs, actually.
Oh, okay.
For domestic Disney Plus, ARPU increased 4%.
Right.
From $770 to $799.
Okay.
International Disney Plus saw an even bigger jump, 6%.
Oh, wow.
From $678 to $719.
Okay.
And Hulu Live TV plus SVOD also had a solid 4% ARPU increase.
Okay.
Going from $95.82 to $99.22.
Okay.
Interestingly, Hulu SVOD only's ARPU was relatively stable at $12.52.
So it seems like they're doing a good job of increasing that revenue per user.
Yeah. And that's going to be key.
Yeah.
If subscriber growth plateaus, it's a lever they can pull to maintain and grow the profitability of their streaming business.
Makes sense. So what are the main factors driving those ARPU increases then?
There are a few factors at play.
Okay.
For both domestic and international Disney Plus, they cited increases in subscription prices as a key driver.
Right.
International also benefited from higher advertising revenue.
Okay.
It's worth noting, though, that they did mention a higher proportion of subscribers opting for promotional offers.
Great.
And that partially offset those increases.
Got it.
For Hulu SVOD, even though overall ARPU was flat, they saw lower advertising revenue. But that was balanced out by price increases and more subscribers choosing those pricier multi-product bundles.
All right.
And then for Hulu Live TV plus SVOD, the increase was primarily due to higher subscriber-based fees for programming.
Okay, so probably reflecting rate adjustment.
Yeah, exactly.
Okay.
Yeah.
Moving on to content sales, licensing, and other.
Okay.
That sub-segment had a really impressive revenue jump.
It did.
What was behind that?
So that 34% revenue increase was mainly driven by higher revenues in TV VOD and home entertainment distribution. Right. Along with a significant increase in theatrical distribution revenue.
So movies hitting theaters and home video.
Exactly.
Yeah.
The operating income for this segment also swung from a $224 million loss to a $312 million profit. Okay. However, they did point out that higher theatrical marketing costs impacted their selling, general, and administrative expenses.
All right. So successful quarter on the content sales front.
Yeah, absolutely.
Okay, let's turn to the sports segment now.
Okay.
Overall revenue was flat.
Yep.
Which seems a little surprising.
Yeah, you would think.
Yeah, you would think.
Yeah, with sports content always in demand.
Right, exactly.
So this really highlights the impact of the Star India transaction again. While Star India revenue plummeted around 90%, both ESPN domestic and international showed pretty healthy growth, 9% and 7% respectively. Right. Operating income for the sports segment did increase by 15%. Okay. But again, that was influenced by the changes related to Star India. Right. And we also saw a slight dip in ESPN Plus paid subscribers, down 3%.
All right. And how about affiliate revenue across the different ESPN entities and just, for folks at home, affiliate revenue? That's just
affiliate revenue is the money they get from cable and satellite companies for carrying their channels.
Exactly.
So for ESPN domestic, affiliate revenue was comparable to the prior year. Okay. They saw a 7% increase due to higher effective rates they were able to negotiate. Okay. But that was offset by a 7% decrease. Right. From having fewer subscribers on those traditional platforms.
Got it.
International ESPN affiliate revenue decreased. And they attributed that to unfavorable foreign exchange rates and a smaller impact from subscriber losses. Right. Although higher rates largely mitigated that. Right. And then for Star India, affiliate revenue was down significantly, 52%, again reflecting the impact of that transaction.
The Star India story continues.
It does. Yeah, it's a big one.
Okay. Finally, let's look at the experiences segment.
The parks.
Yeah, theme parks and resorts.
The resorts.
Seems like that's consistently a strong performer.
Always a good time at the parks.
It is. It is, yeah.
So revenue in the experiences segment increased by 3%. Okay. This growth was fueled by higher theme park admissions. Okay. Where they saw increased per capita spending.
Right. So folks are...
Oh, yeah. People are spending
more in the parks?
Yeah. However, this was partially offset by lower attendance at their domestic parks.
Interesting.
Yeah.
Any reason given for that?
They specifically mentioned that it was impacted by hurricanes at Walt Disney World Resort.
Okay, that makes sense.
Yeah. On a brighter note, though, their international parks did see growth in attendance.
Right.
The resorts and vacations part of the segment also performed well, driven by higher average daily hotel rates and continued growth in Disney Vacation Club.
So people still going to those parks?
Yeah, they are.
Yeah.
Despite the revenue increase, though, the operating income for the experiences segment remained flat.
Okay.
So interesting to see that increased spending and the international growth weren't enough to boost the operating income.
Interesting. Okay. Let's shift gears a little bit and talk about content spending and amortization.
Yeah.
This is a huge area.
Huge area for this company.
Yeah.
So what are these reports telling us about that?
So total produced and licensed content assets actually decreased slightly compared to the previous quarter.
Okay.
If you look at the amortization of these costs, that's how they basically account for the expense of that content over time.
Right.
It was $6.6 billion for this quarter, down from $7.15 billion in the prior year.
So the accounting for that content as an expense is down a bit.
It is a bit.
Yeah.
But for the full fiscal year 2025, their current expectation is that their total spend on creating and acquiring content will be comparable to fiscal year 2024, which was around $23 billion.
So still investing a ton in new content.
Huge investment.
Okay.
Yeah.
Any other significant financial details?
Yeah, there are a few other things that are worth mentioning. We saw an increase in overall depreciation and amortization.
Okay.
Some of that was offset by lower amortization related to the TSCF and Hulu acquisitions.
Yeah.
You know, those assets are now more mature in their accounting life cycle.
Yeah.
But the increase was mainly driven by higher depreciation within their experiences segment.
Okay.
Likely tied to those investments we talked about.
Right.
Net interest expense also increased significantly, and that was attributed to both lower interest income they earned and lower investment income.
Okay.
In terms of how they're managing their capital, they repurchased 7 million shares of their own stock for $0.8 billion during the quarter. And they're still aiming for a total of $3 billion in share repurchases for the full fiscal year 2025.
All right.
They also declared a dividend of 45 cents per share, which is payable in July.
Okay.
And then we also saw a decrease in their cash and cash equivalents on hand. But it's worth noting that they still have a lot of unused borrowing capacity.
Okay.
$12.25 billion through their bank facilities.
All right, so they got
some flexibility.
Yeah.
Yeah.
What about any ongoing legal matters or potential future obligations?
Yeah, so there are a few ongoing legal situations to keep an eye on.
Okay.
The securities class action lawsuit and the shareholder derivative complaints related to the past reporting of Disney Plus subscriber growth.
Okay.
Those are still in the preliminary stages, and at this point, the company can't really estimate potential financial losses associated with them.
Right.
There are also antitrust lawsuits concerning the pricing of virtual multi-channel video programming distributors.
VMVPDs.
VMVPDs.
Yeah.
And they mentioned reaching settlements with Fubo in this area.
Okay.
These cases are also in early stages, so the financial implications are still uncertain.
Right.
And then finally, there's the ongoing situation with Hulu LLC and the exercise of the put option by NBC Universal.
Yeah.
The initial payment was $8.6 billion.
Okay.
But the arbitration to determine the final fair value of Hulu is still underway.
Yeah.
So the potential for an additional payment is still an open question.
Okay, so lots of moving pieces on the legal front.
Yeah, absolutely.
And then, of course, both the earnings report and the 10Q.
Right.
They always include those, cautionary statements about the future.
Of course, those are standard.
Yeah.
So both documents contain forward-looking statements.
Right.
And they explicitly caution that actual results could differ materially from their current expectations due to a whole range of risk factors. Yeah.
This includes things like overall economic conditions, the intensely competitive media landscape, shifts in consumer preferences, evolving regulatory environments,
of course,
and just numerous other factors that are outside of their control.
Right.
It's a standard reminder.
Yeah.
But it's an important one.
Yeah.
Predicting the future is hard.
It is. It is.
Yeah.
And it's also important to remember that these financial results, are built on certain assumptions and estimates made by the company's management.
Absolutely.
Especially when it comes to how they account for revenue and the costs associated with their content.
So that's a really crucial point.
Yeah.
The financial results presented, they rely on significant judgments and estimates made by management.
Yeah.
Particularly in areas like how they recognize revenue from various sources.
Yeah. The rate at which they amortize.
Right.
The massive costs associated with their content library and how they assess whether the value of their assets has been impaired.
Okay.
So factors like the box office performance of their films, the viewership ratings of their television programs, the projected usage of their streaming platforms, all these things play into those estimates.
Right.
And there's always uncertainty in forecasting those things.
Of course. Yeah, no crystal ball.
No crystal ball.
Okay, well, we've covered a ton of information.
We have.
Really dove deep into these reports.
We did a deep dive.
Let's try to synthesize it all for you, the listener.
Sounds good.
What would you say are the most important?
All right, so key takeaways from this first quarter of fiscal year 2025.
Yeah.
So overall, we saw solid growth in both revenue and net income.
Right.
But it's really important to look beyond those top line numbers.
Okay.
The performance of their different business segments varied.
Right.
And the completion of the Star India transaction has had a really significant impact on their financial results and their strategic direction.
Exactly.
In the direct-to-consumer arena.
Yeah.
While subscriber growth was mixed, their success in increasing ARPU for most of their streaming services.
Right.
That's a key positive trend to watch.
It is, yeah.
The substantial increase in investment